2025 felt like the global economy and financial markets were playing a high-stakes game of chicken. On one side, the bears were screaming about an imminent recession, citing inverted yield curves and cooling labor data. On the other side, the bulls were buying AI stocks like they were the last water bottles in a desert. But as the year unfolded, something strange happened. Nothing broke. Unemployment stayed low, consumers kept swiping credit cards as if the debt wasn't real, and anyone who dared to short NVIDIA or the Magnificent Seven aged a decade in just 12 months. It was a year of confusion, a year of wrong predictions. And now, as we step into 2026, the fog isn't lifting, it's getting thicker. We are facing a crossroads, a soft landing, a hard landing, or the most chaotic scenario of all, no landing. This is the year where markets could blow the top off in a final speculative blow-off top. Or it could be the year you look back and realized you should have just parked your capital in boring 5-year treasuries and walked away. Since I've been flooded with messages asking for my 2026 outlook, I decided to lay it all out in one deep dive. Let's start with the bear case, because as an investor, you have to be emotionally wired for disappointment. The elephant in the room isn't just AI, it's the price we are paying for it. Right now, NVIDIA trades at roughly 47 times earnings. Palantir is sitting at a staggering 400 times earnings, and Datadog over 430 times. This isn't investing based on cash flows or fundamentals anymore. This is pre-ordering hope at a premium price. The problem is that these AI giants are dragging the entire S&P 500 up with them. When NVIDIA moves, it moves the semiconductor sector, which moves tech, which moves the entire index. Currently, the S&P 500 is trading at nearly 31 times earnings, almost double the 100-year historical average of 16. If these multiples simply normalize, not crash, just go back to normal, the hit to your portfolio would be tectonic. We are also seeing a circular spending problem, AI companies selling to other AI companies, while 95% of traditional businesses are still seeing zero actual ROI from generative AI tools. If the revenue doesn't show up in the 10Ks soon, the music might stop abruptly. Beyond valuation, we have a structural nightmare, market concentration. The S&P 500 is no longer a diversified representation of the American economy. It's a concentrated bet on 7 companies. The Magnificent Seven now make up over 35% of the entire index's market cap. In early 2025, they accounted for over 50% of the total market returns. It's like a group project where 2 people do all the work, but if those 2 get sick, the whole project fails. Furthermore, the explosion of passive indexing is pouring gasoline on this fire. Because most ETFs are market cap weighted, every new dollar invested is forced to buy more of the biggest stocks, regardless of price. It's a self-fulfilling feedback loop that works beautifully on the way up, but creates a liquidity black hole on the way down. A 10% pullback in 1 or 2 names can trigger a cascade of selling across the entire NASDAQ and S&P 500, turning a minor correction into a systemic liquidation event. Statistically, we are overdue for a 10% pullback, which happens on average once every 3 years. But what if the bears are wrong again? What if gravity doesn't apply? The bull case for 2026 rests on one pillar: liquidity. Whether you trust the Fed or think Jerome Powell is guessing, the trend is clear. Interest rates are coming down. 2025 ended with a streak of 25 basis point cuts, and the consensus for 2026 is more of the same. Lower rates mean cheaper capital for corporations and more attractive valuations for tech. When the risk-free rate drops, investors are forced to move further out on the risk curve to find returns. This creates a floor under stock prices. Even if the economic data is mixed or uncomfortable, as long as the Fed is providing a liquidity safety net, the path of least resistance for the market remains higher. This is the classic "don't fight the Fed" mantra that has humiliated bears for the last decade. The other half of the bull case is fiscal policy. While we argue about 0.25% rate cuts, the U.S. government is running a deficit of over $1 trillion a year. This is massive stimulus injected directly into the veins of the economy. Government spending supports employment, props up corporate revenues, and keeps the engine humming even when private investment cools. In an election cycle or a post-election year, politicians rarely have the stomach for frugality. Budgets don't get slashed overnight. This fiscal dominance means that even if we see a slowdown, the sheer volume of money being printed and spent creates a nominal tailwind for assets. In this environment, cash is trash, and stocks, specifically those with pricing power, become the ultimate inflation hedge. Here is the scenario nobody is talking about: the gray area. Not a moon mission, not a crash, but a long, painful, sideways grind. Imagine a year where headlines flip from hyper-growth to stagflation every 2 weeks. Rallies stall just as you get bullish, and dips feel scary but never offer a clear bottom. This is the choppy market that destroys retail traders through overtrading and impatience. In 2026, we might see capital rotation, money moving from big tech into small caps, then into commodities, then back to bonds. It's a market where every decision feels wrong and every stock feels eerie. This sideways action is often more dangerous than a crash because it kills you with 1,000 small cuts rather than one quick blow. It tests your discipline and your ability to do nothing when the noise is at its loudest. As we navigate 2026, remember this: anyone who tells you they know exactly what happens next is lying or trying to sell you a course. The market is a complex, adaptive system that doesn't care about your feelings or my bear case. The best thing you can do is stay liquid, stay diversified, and keep your ego out of your trades. Whether we see a final AI-driven blow-off top or a long overdue reversion to the mean, the winners will be those who prepared for all scenarios instead of predicting just one. So, where do you stand? Is 2026 the year the bubble pops, or are we just getting started? Let me know in the comments. And if you're looking to upgrade your setup for the long hours of research ahead, check the link in the description for a special offer. Stay safe, and I'll see you in the next one.